Meta money.
Ooh. We're using meta money to get long because the puts are paying for it, right?
Swiggity swooty.
What's happening, everybody? It's your boy Chicago Sean McLaughlin, joined by my man Steve Strazza, the head technical analyst here at All Star Charts. What's up, Strazza?
Not much, man. How are you?
Dude, I'm very good. I was late to this little meeting. I was the last to tune in, and I was expecting to see JC on the other side, and I saw you, and I was pleasantly surprised, my friend. Thank you for filling in.
Happy to make your day.
It makes my day. You know, we had an analyst meeting this morning, and JC was in his car on his way to a lunch meeting, and I point blank asked him, does this lunch meeting mean you're not going to be able to do our video later today? He's like, oh, no, we'll definitely do it. We're right on track. And Straz and I were both like thinking to ourselves, there's no way he's going to make it. And sure enough, about 5 minutes before we're supposed to go live, JC lets Strazza know that he needs Strazza to fill in for him. So here we are, rolling with the punches. JC's having lunch with a work colleague, claiming to be doing business. I call BS on that.
I'm just always waiting. I'm warmed up. I'm on the bench ready to go. Like if there was just a sixth man of the year award, like that used to be my favorite award in the NBA. I'm the sixth man of the year.
You're the sixth man. You're always suited up. You got the shoes tied. You got the laces tight. You just like, put me in, coach. I'm ready.
That's it.
That's what we love about you. All right. So let's get right to it here. In our analyst meeting, we were talking about some trades that we liked, and Meta, the cool kids call it Facebook, stuck out because we had this huge gap following January earnings. We've had some pullback with everything else that's pulled back in the market over the last 3-4 weeks, but we're liking the way it's holding here. It never filled that gap. And from a tactical trading perspective, it really feels like it's setting up for a nice reward to risk scenario where we could play for a big win without risking a whole lot of money because we have a very clearly defined stop loss level right there around 167, which is last week's low. Am I making sense here, Strazza?
I mean, listen, it's no longer 2022. It's 2023 now, and Meta is a leader. This is a stock that we want to buy, not run for the hills from like last year. So, you know, this is a huge company. Meta's got a market cap just below $500 billion. It's tacked on about $250 billion in market cap since early November. It's been a huge move. Like I said, now a leader. You got that power earnings gap. We have a nice level that we can use to get out. Is it the pivot lows? Is that where your head's at?
That's where my heads are at right there, right around 167. Kind of that's what was that, Monday's low or Friday's low?
Right.
I forget, but
so keep it really tight and bet on a fresh leg higher or continuation of what is now like a very, very strong uptrend on a tactical basis.
Right. And look, if the market resumes higher from here, we feel pretty strongly that, you know, Meta is going to be one of the leaders. And look, it's got, whether you agree with it or not, Meta's got mind share, right? Like people know what Facebook is. Everybody who likes Facebook can be bullish on Facebook or whatever. It's one of those names that like the sentiment will catch up to it. People will kind of jump on that train if that thing's going. Now, that said, we are playing this trade not, we're being more tactical. We're not taking a longer term bet. We are trading in May options. So we're looking more for kind of a shorter term run back up towards those 200 highs, which is where, the just about the level we got to in early January. We're making the bet that Facebook, if it holds here and the market finds its footing, Facebook's going to make a run at that level, at least try to retest that upper bound there around 200. And we are going to sell puts to pay for calls. The old risk reversal, one of JC's favorite trades.
So why did it make sense to craft this position as a risk reversal?
So good question, because the first thing that we looked at when we were first looking at this trade is, well, where's the implied volatility? Because that's always the first thing I look at when I'm considering putting an options trade on. And implied volatility is actually pretty low right now in Meta, which is not ideal for selling premium. But the thinking that we kind of landed on was, yeah, the premium's low, but we've got a very clear level here that we could lean against, that 167. It's not far away. So we could sell a put just below that strike, or just below 167. In this case, we're selling the 165 puts. We can get meaningful premium at that price. And you know, we already know that if we're wrong, we're gonna know quickly. So we're gonna be able to act on this quickly to get out if we're wrong. But if we're right, man, those puts are going to decay in value really quickly as we approach May expiration, or even if we get into April and Facebook or Meta starts going higher, those puts are going to decay in value very quickly. And the puts that we sold here, you can see in this graphic that Straz has got up on the screen right now, we sold them for around 965, right? So we turned around and took that 965 credit and bought an equal amount of calls at 195 strike that were just, you know, a little bit out of the money, and we paid 895 for them. So there's credit left over here. We were left over with 70 cents. Now, 70 cents is nice. It's not what we're playing for. That's not the win we want to have. But it's nice knowing that if Facebook does nothing, right? It doesn't break our stop loss level, kind of sits here, maybe goes up a little bit, but it doesn't really make any kind of meaningful move. Worst case scenario is we walk away with this credit that we collected today, which is 70 cents. And hey, it's better to get paid when something doesn't work than to lose money when something doesn't work, right?
So this starts heading back to 200. We take half of the calls off, cover all the puts, free ride.
Right. So the way I like to trade risk reversals, and other people do it different ways, but the way I like to do it, what works for me is, if at any point in time, if Meta starts moving higher, as these calls increase in value, if I get to a point where the calls are worth twice as much as the puts, so let's put some real numbers to that. Let's say the calls are trading at $10 a contract, and the puts are now trading at $5 a contract. Well, guess what? I could sell half of my calls and use that money to pay for all of my short puts to close them down, cost me no money, and now I'm left with half of my long calls position at zero cost. In fact, I'll have a remaining credit left over, the credit that I received today, and any credit I may have from this adjustment where I closed the puts. And I got nothing but upside and zero risk, at least zero of my original capital risk. I'll be risking open profits at that point, but I'll risk open profits all day long.
And what if we just kind of like meander here? Like, don't rip back to 200. Just kind of hang out, kick it around this 170, 180 range. There's a chance that those puts could, you know, fall in price so much that you could still do what you're talking about.
Absolutely. Absolutely. If Meta stays here, let's say it trades at 175, 180, it just kind of stays in that range for the next 2-3 weeks. Unlikely, but let's say that happens. Yeah, those puts will start decaying in value. They'll decay faster than the calls will, because the puts are closer to the money. And it's possible that we might get to a point where the calls are trading at $2 and the puts are trading at $1, right? Fine. We'll close the puts, and worst case scenario, we're walking away with the original credit that we still receive. So, as long as, that's a long-winded way of saying, Strasa, that as long as Meta, as long as it never breaks our level of 167, then we're going to make money in this trade. It might not be a lot of money, but we're going to make money. Where we make the big money is if we get the move. If we go back up towards 200, then our long calls really start paying.
And what I really like about it is, so we have that stop at 167. I could draw a little wedge here, right? Since the earnings gap, I could draw a wedge here that we could argue is resolving higher right now. The stock's already pulled back about 12, 13% off of those earnings highs. It spent most of February correcting, just like the broader market. If the broader market is done correcting, you want to be in the leaders like Facebook, right? And the corrective action here, it's kind of played out over the past few weeks following earnings. We see this all the time, right? The big earnings reaction, then the cool off, and then you really want to be involved for those, months later or weeks later after the big earnings move. And if we're timing this right, and that's about to start now, and we get a new leg up, I think this could be a really big winner. And I like picking Facebook for this too.
Is there anything more meta than having the market pay for our bullish positions?
It's meta money. So it's like monopoly money, but better.
There you go. There you go, folks. That's our trade of the week this week. Straza, thanks for pitching in or pinch hitting for JC, or coming off the bench if you want to talk in basketball terms, whatever.
Why don't we just do this? Whenever there's a risk reversal, it should be me and not JC. Like if we just make that rule now, and that could be the game plan, I think that's the move because
that'll rub him the wrong way because the risk reversals are his favorite trades.
They're both of our favorite. We'll have to fight over it. Yeah.
All right, guys. Thanks for tuning in. This has been the options trade of the week. We'll be back next week with a new idea. You guys enjoy the trading day out there. Keep it tight, trade smart, and we'll see you next time. Thanks, Straza.